Welcome back to The Explainer. Today, we are tearing down a massive win in the retail space. We've got a really fascinating case study on our hands, and we are going to completely reverse engineer the financial momentum of one of the absolute biggest names in jewelry, Kalyan Jewelers. By digging through their latest quarterly results from May 2026, along with the detailed ratings rationale from ICRA, we're going to decode exactly how they managed to engineer such a remarkable run. Okay, let's jump right in. Let's just start right with the cold hard cash, because on May 8th, 2026, the board of directors dropped a very pleasant number on their shareholders. They recommended a massive final dividend of 2.50 rupees. That is a 25% dividend per equity share for the financial year ending March 2026. And look, when a company is handing out that kind of dividend, it's basically a giant neon sign pointing to some incredibly strong underlying financial health. And, they didn't just pull that dividend out of thin air. It is heavily backed up by the numbers. We're talking about a staggering 35% year-over-year revenue growth in just the first 9 months of FY 2026. And this isn't just a sudden slight uptick either. This actually follows a 35% consolidated operating income rise in FY 2025, plus a solid 30+% growth in the years before that. So we're looking at a sustained high-speed sprint. Which brings us to the burning question we're answering today. How exactly does a traditional regional South Indian jeweler pull this off? How do they unlock this kind of explosive, modern financial growth? What's the secret blueprint here? Well, spoiler alert, it all comes down to a really radical change in how they run their stores. Section 1. Their asset-light strategy. For decades, being in the jewelry business meant one thing: tying up hundreds of millions of dollars in heavy, incredibly expensive gold that just sits there in display cases. But Kalyan flipped the script. They introduced what's called the FOCO model. That stands for franchisee-owned, company-operated. This is the literal definition of asset-light retail. Under this model, the heavy lifting, meaning the store's gold inventory, the capital expenditure to actually build the store, and most of the operating expenses are all borne by their franchisee partners. The main company still operates the store, right? So they maintain all their brand standards, but they let the partners carry the financial weight. The contrast here is a real game changer when you compare the new FOCO model to their old COCO model, company-owned, company-operated. Back in the old COCO days, Kalyan had to buy all that gold and build all those stores themselves. By shifting that massive inventory burden to their franchisees, they dramatically reduced their own working capital requirements. In fact, the ICR report points out that their inventory days fell from 221 days in FY 2022 all the way down to 156 days by FY 2025. And here is the mathematical proof that this is actually working. When you don't have all your cash trapped in inventory, your capital efficiency just skyrockets. Their return on capital employed, or ROCE, jumped from a modest 8.9% in FY 2022 to a really robust 14.4% in FY 2025. If you're analyzing a retail business, this is exactly the metric you want to see. It proves the asset-light strategy is hitting the nail on the head. So how committed are they to this engine? Oh, they are all in. By December 2025, they had rolled out 268 of these FOCO stores. To put that into perspective, in that exact same time frame since FY 2023, they only added 46 of their own company-operated stores. They found their golden goose, and they are scaling it up as fast as humanly possible. All right, let's move to Section 2, the fuel, diversifying the shine. Having a super efficient store model is great, but obviously you still need to sell the right products in the right places. A huge part of this strategy is a massive geographical shift. Historically, Kalyan Jewelers had its stronghold in South India. In FY 2022, their revenue share from non-South markets was just 34%. But by FY 2025, that jumped to 51.9%. And in the first 9 months of FY 2026, it actually overtook their traditional stronghold, hitting 54.4%. They pulled off a phenomenal compound annual growth rate of 52% in non-South revenue over just 3 years. They're definitely not just a regional player anymore. We are looking at a pan-Indian giant. And breaking into these new non-South markets allowed them to do something absolutely crucial: push studded jewelry. Plain gold jewelry is great, but it often functions kind of like a commodity with pretty thin margins. Studded jewelry, on the other hand, we're talking diamonds and precious stones, acts as absolute rocket fuel for profit margins. And it just so happens that the demand for studded jewelry is relatively higher in these newly conquered non-South markets. So we see this steady upward climb. Studded jewelry's share of their revenue grew from 26% in FY 2023 to 30% in FY 2025,
and ticked up yet again to 31% in the first 9 months of FY 2026. Think about that combination. Expanding rapidly with an asset-light model, moving into fresh territories, and selling higher margin products. It is just a masterful strategic mix.
Section 3. Navigating Industry Headwinds. Now look, no business story is all sunshine and rainbows, right? In this explainer, we always want to impartially examine the external risks, and the retail jewelry sector has plenty of them. Let's walk through these headwinds. First off, they operate in a highly fragmented, intensely competitive market. They are fighting huge organized brands and local unorganized jewelers, which naturally puts a ceiling on how much they can raise prices. Then you have regulatory curveballs. For instance, the documents note a 9% customs duty cut back in July 2024. While that's helpful in the long run to curb illegal imports, it caused a sudden one-time inventory loss that temporarily dinged Kalyan's operating margins by about 0.5% in FY 2025. Plus, of course, you always have the constant threat of wild fluctuations in global gold prices. So how on earth do they defend against those wild gold price swings? They actually use a really robust defense mechanism. They hedge 100% of their gold inventory, all of it. They do this through gold metal loans, gold on lease arrangements, and financial derivatives. Essentially, if gold prices suddenly crash overnight, Kalyan doesn't take a catastrophic loss on the gold sitting in their showrooms. This hedging strategy acts as a massive shock absorber, giving vital stability to their profit margins. Section 4. The global horizon. Finally, let's look at where this momentum is taking them next. Because they are definitely not just looking at the domestic market anymore. They already had a very solid base in West Asia that brings in about 12 to 13% of their consolidated revenue. But recently, they've set their sights on the West. In Q3 of FY 2025, they opened a showroom in New Jersey. In April 2025, they launched one in Chicago. And in December 2025, they planted their flag in the UK with their very first store there. They're basically taking this proven formula and exporting it directly to some of the highest value retail markets on Earth. And honestly, the traditional finance world is absolutely eating this up. To give you the ultimate corporate validation, the major rating agency ICRA recently reaffirmed Kalyan's top-tier credit status. They maintained their double A stable rating for long-term limits and an A1 plus for short-term limits across 3,850 crore rupees of instruments. ICRA specifically called out their strong revenue growth, that geographic diversification we talked about, and critically, the lower working capital requirements driven by that genius FOCO model. Which leaves us with one final, pretty provocative thought. We've just watched a traditional, heavily capital-intensive jeweler transform into this incredibly agile, highly profitable, expanding global machine simply by rethinking who actually holds the inventory. So will this asset-light blueprint become the new, unavoidable standard for legacy retail brands everywhere? It is definitely a fascinating question to chew on the next time you walk into a traditional brick-and-mortar store. Thank you so much for joining me for this explainer. I hope you're walking away with a much clearer understanding of the powerful engine driving Kalyan Jewelers right now. See you next time.